discounted cash flow method simplified through a case study for plant and machinery and land and building valuation professional. Sorry. So today in this session, what we are going to cover is one method, and that is discounted cash flow, which is used very extensively across the globe by all the valuation professional. So what we're going to discuss, friends, today, number one is to what is the discounted cash flow method and which are the situations where discounted cash flow method can be used and why discounted cash flow should be used in those situations, and finally how to apply discounted cash flow method in case of a case study. And this case study is in case if you and I were to do valuation of a five-star hotel on discounted cash flow basis, how we would go about doing the valuation of this five-star hotel. Now, this is the plan and the agenda that we have for today. Now, I'm sure, as I'm informed, most of the participants that we have today are from the domain of land and building valuation and plant and machinery valuation. Therefore, it is quite possible that there may be some extra queries in the minds of all the participants that we have here with us. And to ensure that today's session becomes a purposeful, today's session that we have becomes meaningful, today's session makes value for all of you, I would encourage all of you to please feel free as we go about the whole discussion to interrupt me and ask your question. My only request is ask me a question about something that I am discussing with you, and that thing which I am discussing with you is not clear to you. If that is what is happening, then please feel free to interrupt and raise your doubt, raise your question, so that throughout this session we are completely on the same page. Of course, in the end, I would leave some time for question answers also. So in case if there are any other question, we would take those questions towards the end of the session. Now, let us begin our session with valuation conundrum demystified. Now, friends, I'm going to discuss with you certain questions, and I'm sure once our understanding about these questions becomes absolutely clear, then we would be able to answer any question on valuation without any difficulty whatsoever. So, what are the points that we are discussing? Number one, what is value? And let me tell you, friends, in very simple words, what is value? Value is nothing but utility of an asset, period. Value is nothing but utility of an asset. An asset will have value only when it has some utility. If an asset does not have a utility, it will not have value. So that is number one that we need to remember as to what is value. Value is nothing but utility of an asset. Number two, what is valuation? What is valuation? And remember, friends, valuation also, the definition of valuation can also be simplified in very simple words. So what is valuation? Valuation is converting or quantifying utility of an asset in terms of money is valuation. Quantifying an asset in terms of money is valuation. So please excuse me in case you find me Please excuse me in case if you find me coughing in between, because today I have a very bad throat. But I'm sure as we progress, we would be able to manage it. So what is valuation? Valuation is quantification, utility of an asset in terms of money, and that is valuation. Very simple definition. What is value? Utility of an asset. What is valuation? Quantifying this utility of an asset in terms of money. Money is valuation. Why do we do valuation? We do valuation because we have to take a decision. Why do we do valuation? We have to take a decision. Please remember, if I was not to do, if I was not to take a decision, if my client was not to take a decision about an asset, obviously we will not do the valuation. So we will do valuation of an asset or a liability only in a situation when we need to take a decision about that asset. And that decision can be of anything, as we all know. It can be for the purchase of the asset, it can be for the sale of the asset, it can be for the transfer of shares, it can be for the merger, acquisition, it can be for the purpose of financial reporting, it can be for the purpose of compliance, doesn't really matter. Ultimately, so what is valuation? Valuation is, why valuation? Valuation because we have to take a decision. Question number 4. What we find through valuation? तो हम वैल्यूएशन के थ्रू क्या फाइंड करने की कोशिश करते हैं? एंड फ्रेंड्स, आंसर अगेन इज वेरी सिंपल. थ्रू द प्रोसेस ऑफ वैल्यूएशन, what we are trying to find out is the fair value of that asset or fair value of that liability. As simple as that. Fair value, we all understand. So what is fair value? Fair value, of course, is something which is fair to both the parties, which is fair for both the parties, and that is the fair value. So whenever we are trying to do valuation of any asset, doesn't really matter whether it is plant and machinery, or it is land and building, or it is shares of a company, or debentures of a company, or a company itself. What we are trying to find out whenever we are doing valuation, we are trying to find out as to what is the fair value of this asset. Question number 5. Question number 5. Question number 5, how to do valuation, and that is what I am going to discuss with you in little more detail, and also how to use discounted cash flow. So I am sure, friends, good understanding of all these 6 questions that I have just discussed with you will completely answer all questions of the conundrum called valuation. And please also remember, whatever I have discussed with you just now as to what is value, what is valuation, why valuation. So whatever I have discussed with you just now, please remember, is equally applicable in respect of all kinds of assets. Assets relating to land and building, assets relating to the plant and machinery, and assets relating to the securities or financial assets. Now, having understood this, let us come and to the 5th question that I have shown you here. And the fifth question is how to do valuation. Now, this is how we would do the valuation. So there are basically 3 approaches to valuation, as all of us know already. The valuation approach, I'm sure all of you are more familiar, is about the market approach and about the asset approach. But besides the market approach and the asset approach, which is also known as cost approach, we also have one more approach of the valuation, that is the income approach of valuation. Now, what is income approach of valuation? Very simple. When income is the basis for deriving value of an asset, that is income approach of valuation. Under the income approach, there are 2 methods. Primarily, there are 2 methods. Method number 1 is known as income capitalization method, which is not the topic of our discussion today, but just to give you some idea. What is income capitalization method is very simple. You find out as to what is the normal income of a company that you are trying to value. What is normal as the income of a company that you are trying to value, or company or an asset that you are trying to value. find out the normal income, find out what is your expected rate of return, what is your opportunity cost, capitalize this normal income by your cost of capital, and what you will get is value of that asset. The second method under the income approach is discounted cash flow method, and that is what, friends, we are going to focus on today. And then market approach, of course you are aware, asset approach, of course you are aware, and therefore I am just not going to discuss them and spend time on them because we have a limitation of time in any case. Now, as regards the income approach, please remember, income approach is most fundamental, most dependable and reliable. Ignore at your own risk. So in case of land and building, in case of plant and machinery, sometimes you may be doing valuation of a land and building or a plant and machinery which does not have the capability of generating cash flow. In those cases, you will be doing the valuation of land and building or plant and machinery on comparable transaction method basis or based on the cost basis or asset basis. But when you have an asset which has got cash generating capacity, then the approach that you would use is the income approach. And please remember, land and building can also have the capability of generating cash flow. So hospital is nothing but combination of land and building, and it has the capability of generating cash. So a hospital can be valued based on the discounted cash flow. A hotel is nothing but a combination of land and building, and a hotel has a capability of generating cash flow, and therefore a hotel can also be valued based on the discounted cash flow. So whenever we are doing valuation, the income approach becomes the most fundamental. And why do I say that income approach becomes most fundamental? And that is because I am sure, friends, in the recent past you must have noticed a company called Zomato came out with a public issue. The issue price was 76 rupees and the face value of that company's share was 1 rupee, and that 1 rupee share, when this share got listed, it got listed at about 140 plus amount. So 1 rupee share, issue price is 76 rupees, and it is getting listed at 140 plus rupees on the stock market. How this 76 rupees was decided as the issue price? Not on the discounted cash flow. It was decided based on some parameter. Today, what is the price of Zomato on the stock market? Today, the price of Zomato on the stock market is 70 plus. So, and why is that so? That is because whenever any other method is used other than the discounted cash flow, the risk of fluctuation in the valuation in subsequent periods are very high. And that is why I would always recommend that whenever you are doing valuation, use the discounted cash flow method, because that is most authentic, most dependable, most reliable, and most accurate. In case of market approach, of course, market approach for a company or for any asset which is listed on a stock market, on an exchange, then the quoted price can be a good basis for the purpose of valuation. But in my view, quoted price is fine, because I understand that quoted price is nothing but is the collective wisdom or is the force of the market that decides the quoted price. But please remember again, here also quoted price is okay, but then ultimately what we must do, we must back and check, cross check the quoted price with the discounted cash flow. And of course the third approach, which is the asset approach or the cost approach, and that's where this approach will give you the downside. So cost approach or the asset approach will mostly be used in case of the liquidation of the company, and so in case of liquidation of the company or closure of the company, that is where you would use the asset approach, And the asset approach will basically give you the downside value of an asset. Now, as valuation professional, arriving at the fair value by using whichever approach or method got to be our main driver. So whenever we are doing valuation, doesn't really matters to what the asset is. The asset can be plant and machinery, the asset can be land and building, the asset can be a company, the asset can be any other asset. So what is the prime driver of us as the valuer of that asset? And that is nothing but the what that is to find out the fair value. Now, what is a discounted cash flow method? So let's understand what is discounted cash flow method. So value of an asset is nothing but utility of the asset. Valuation is what? It is quantification of what utility in money, what is nothing but quantification of that utility in terms of money. Why valuation is done? Valuation is done for the purpose of decision making. In valuation, what do we try? In valuation, we try to find out the fair value. And how do we do the valuation? So we do the valuation using different approaches and different methods. Discounted cash flow method is one of them. Now, in case of discounted cash flow method, valuation is done based on the future earning, and that is what we need to understand at this point in time. So whenever we are trying to use the discounted cash flow method for the purpose of valuation, please remember the fundamental to the discounted cash flow method that it is based on the future earnings. So that means कि भविष्य में ये कंपनी कितना कैश फ्लो अर्न करने वाली है, that cash flow is going to be the basis for the purpose of valuation. And meaning what? And please remember, जैसा कि मैंने आपसे पहले कहा, वैल्यू क्या है? यूटिलिटी ऑफ एन एसेट. वैल्यूएशन क्या है? क्वांटिफिकेशन ऑफ दैट यूटिलिटी इन टर्म्स ऑफ मनी. सो डीसी डिस्काउंटेड कैश फ्लो मेथड में व्हाट आर वी डूइंग? वी आर फाइंडिंग आउट कि ये कंपनी फ्यूचर में कितना कैश जनरेट करने वाली है, ये कंपनी फ्यूचर में कितना कैश जनरेट करने वाली है, और वो जो फ्यूचर में कैश जनरेट होगा उसकी प्रेजेंट वैल्यू क्या है. Total of this present value of all the cash that the company would generate in future is nothing but the value of that company based on the discounted cash flow method. Now we will understand friends कि जब हम discounted cash flow method use करते हैं तो अब जरा समझ के लीजिए, जब हम discounted cash flow method use करते हैं तो हम क्या करते हैं? हम उस कंपनी का, उस एसेट का जो फ्यूचर कैश फ्लो है अगले 10, 15, 20, 50, 100 साल जो भी पीरियड है, उसका हम फ्यूचर कैश फ्लो फाइंड आउट करते हैं पहले. और हम सभी समझते हैं बड़ी आसानी से कि वैल्यू ऑफ मनी चेंजेस विद द पैसेज ऑफ टाइम. क्या मतलब है? मतलब यह है कि आज की तारीख में मेरे पास जो 100 रुपये हैं और आज से 1 साल के बाद में मेरे पास में जो 100 रुपये होंगे उनकी वैल्यू सेम होने वाली नहीं है. मतलब क्या है? मतलब ये है कि 1 साल के बाद मेरे हाथ में जो 100 रुपीज़ होंगे, दोज 100 रुपीज़ आर गोइंग टू बी मच लेसर इन टर्म्स ऑफ वैल्यू देन दी 100 रुपीज़ दैट आई हैव इन माई हैंड टुडे. अपरेंटली सेकेंड ईयर में जो 100 रुपये होंगे उसकी वैल्यू फर्स्ट ईयर के जो 100 रुपये हैं उससे भी कम होगी. इसका मतलब क्या है? इसका मतलब ये है कि फॉर ऑल दी टाइम्स टू कम जो भी मेरा कैश फ्लो है वो कैश फ्लो की वैल्यू कम होते जाने वाली है. और अगर उस कैश फ्लो की वैल्यू कम होते जाने वाली है, यानी कि जो मेरे हाथ में पैसा आएगा उसकी वैल्यू कम होते जाने वाली है, इसका मतलब क्या है? इसका मतलब ये है कि टुडे व्हेन आई एम इन्वेस्टिंग मनी इनटू अ प्रोजेक्ट एंड टुमारो व्हेन आई एम गेटिंग मनी फ्रॉम द प्रोजेक्ट, राइट, दीज टू कैश फ्लोज आर नॉट कंपेरेबल. These two cash flows are not comparable. So if they're not comparable, I cannot compare them. If I cannot compare them, then I cannot take a decision. But decision I have to take. So if I have to take a decision, what do I need to do? I need to make the future cash flows comparable with the cash flow of today. And how do I do it? I will do it by discounting the future cash flows. So when I discount the future cash flows, I convert them in terms of present value. And when I convert them in terms of present value, that means there is a apple to apple comparison possible now, and I would be able to take a decision. Okay, so I could see that somebody has raised a hand. You can please go ahead. You can unmute yourself and you can please raise your doubt.
Sir, please speak in English only, sir.
All right, okay, that's fine. Okay, no worries. Okay, Sunny, that's okay, perfect. Very good. So, okay, no other question other than that, Sunny?
No, sir. No
Oh,
other thing.
very good. Everything is understood now by now.
Yeah, now it is understood.
Any doubt in the minds of anyone on whatever we have discussed so far? Okay, no worries. Good. So that is discounting. Now, please remember, discounted cash flow method is invariably a two-stage discounting model. And what is the meaning of two-stage discounting model and why it is two-stage discounting model? Let us understand that. Let us understand that. So please remember what we are trying to understand in this session. We are trying to understand in this session how to do valuation of an asset which can be a land and building, which can be a plant and machinery, and which has the capability of generating independent cash flow. That is what we are discussing. Now, we also understand by now that what is the basis in case of discounted cash flow method for the purpose of valuation. The basis is future cash flows.
Sir, I have a question, sir. I have a question.
Yeah,
What
please.
is the meaning of अपने independent cash flow?
Okay, very good.
In a factory.
Yeah.
Suppose in a factory we have three sections.
Right.
One is अपना sheet metal section, one is casting section, one is machining section. So अपना वो तीनों ही independent. They अपना three of them are dependent on each other.
Right. Okay, Deepankar, very good point. Very good point. And when I say that the asset has capability of independently generating cash flow, it means what? It means in your factory, three departments may be interdependent for their processes. But is it possible for these three units to sell their output independently in the market at a price and generate cash flow? If that is what is possible for any asset, that means that asset has the capability of generating independent cash flow. So any such asset which has the capability of generating independent cash flow, that asset can be valued using the discounted cash flow. So all of you, please remember, including Deepankar, all the assets.
नहीं सर इसमें ये है कि अपना all the machines are अपना dependent on each other ना. Suppose in my factory I have 10 CNC machines. One is for turning, one is for another operation, one is for another operation. Then how can I अपना evaluate the single machines अपना using DCF?
No, yeah, that is Deepankar, please pay attention. That is what exactly I am telling you. Only an asset which has the capability of generating independent cash flow, then only that asset can be valued using a discounted cash flow method. If that asset or a group of assets put together do not have the capability of independently generating cash flow, then such assets cannot be valued using the discounted cash flow. So the fundamental principle is, if any asset has to be valued based on the discounted cash flow, that asset or that group of assets should have the capability of independently generating cash flow. So if that capability is not there, then that asset cannot be valued as per the discounted cash flow. So in your case, assuming that you have three different processes, but those three different processes cannot be sold in the market and thereby cannot have the independent cash flow, and therefore it would be difficult, it would not be possible to do the valuation of these three processes using the discounted cash flow. Meaning what? Meaning in that case, all the three processes put together have the capability of generating independent cash flow, and therefore all the three processes put together can be valued using the discounted cash flow and not the separate unit. That is what is the meaning of what I am trying to say. Hope that makes sense to you, Deepankar.
यस सर पर सर जब हम अपना मशीनरी का वैल्यूएशन रिपोर्ट बनाते हैं, जहां तक मेरे को मालूम है कि अपना हर एक मशीनरी का अलग अलग वैल्यू देते हैं, तो अभी आप ये कहना चाह रहे हैं कि मान लीजिए सर हमारी मशीन है अपना पूरी
हाँ.
पूरी 50 करोड़ रुपीज, और अपना अपना मान लीजिए अपना यही सेट अपना मशीन का मेरे पास है, यही सेट अपना किसी और के पास है,
राइट.
जो मैं उसका अपना रेवेन्यू जनरेट कर पा रहा हूँ, वो मैं अपना कर पा रहा हूँ लेट अस से अपना 100 करोड़ रुपीस पर अपना एनुअली.
वेरी गुड.
और जो दूसरा है तो वो अपना जनरेट कर पा रहा है 150 करोड़ रुपीस अपना अपना एनुअली.
वेरी गुड.
पर हमारी मशीनरी की कॉस्ट तो सेम है ना.
राइट. ओके.
तो अपना अगर मैं मशीनरी की कॉस्ट निकालूंगा तो वो तो 50 करोड़ ही रहेगी, तो बाकी जो उसको मैं प्लस प्लस दूंगा तो वो प्लस मैं कहाँ पे लिखूंगा जाके.
राइट. वेरी गुड. Very good, Deepankar. So now please come back to what we discussed a little while ago, that there are three approaches for the purpose of valuation. Approach number one is the income approach. Approach number two is the market approach. Approach number three is the cost approach or the asset approach. Now please remember, the application of these approaches will depend on the situation. So in case if you get an assignment where someone is trying to sell let's say what CNC machine or any other equipment. Now in this case if you have to do the evaluation, and the purpose of the person who is asking you to do the evaluation because he want to purchase the second hand machine. So if you want to purchase the second hand machine, obviously you will not be taking into account the discounted cash flow method. What you will be taking into account, if this second hand machine is to be purchased today, then how much should it cost? So using that estimated cost, you will decide the value of a second hand machine. But please pay attention, but if you come across a client and that client is into manufacturing of some product, and that client has got many machines. Now if you have to do the evaluation of plant and machinery, you have a choice. So what is the choice that you have? The choice that you have is that you can do the evaluation based on the cost approach or the asset approach. The better way of doing the evaluation in such a case will be to do the evaluation based on the income approach. Now please remember, income approach invariably will give you a higher value than the cost approach or the asset approach, because cost approach or the asset approach will only take into account asset, the value of the asset, whereas the discounted cash flow method will take into account the future cash flows. Now please remember, I'll give you a very simple example. You see a very simple example, I'm sure this will put the message across very easily. So you see a lot of people along the roadside who are selling you sugarcane juice. Now the sugarcane juice that they are selling to you, right? So they are using a small machine, a small sugarcane crushing machine, and they are able to convert the sugarcane into juice and sell it to you. Now if you have to do the evaluation of this sugarcane crusher, it can be done in two ways. Number one, it can be done based on at what price it has been purchased. Okay, so that is one value, and that is the cost method. Second can be that this person who is owning this sugarcane crusher, for how many years he is going to use this crusher and crushing the sugarcane and selling the sugarcane juice over the years. So for how many years he is going to use, how much is going to be his cash flow every day, how much is going to be his cash flow for every year, right? And so let's say that this machine will be used by him for next 10 years, and let's say every year he is going to generate a cash flow of 1 lakh every month. So he would generate 12 lakhs for the whole 1 year. So next 10 years he will generate that cash flow. Now using the discounted cash flow, please remember, how will you find out the value? You will find out the value by finding out this person who is owning the sugarcane crusher from over next 10 years, how much is the cash flow he is going to get in his hand, right? And minus all the expenses, of course, because that is what you have to do. So when you minus all the expenses, so from the money that he received minus all the expenses that he incurs over next 10 years, which is the life of the machine, what remains in his hand, discount that cash flow of next 10 years by the cost of capital, which you can say, let's say 15%. Now, having discounted the 10 years cash flow, what is the total? So that is the value of the same asset, the same sugarcane crusher. And friends, that is what, Deepankar, that is what we have to be very, very clear about. Because an asset can have many values depending on what approach you are applying, depending on what method you are using, depending on what is your purpose of doing the evaluation. So I hope that simple example which I have given to you makes it very clear to you.
Yes, sir, it is clear. But on the DCF, if some bank is asking for the valuation, I think we should not apply the DCF. I think.
Deepankar, देखो, remember, it's very simple. In case someone Peru, Mr. Peru, can you please wait for a second? Let me finish. Let me answer this question first. So Deepankar, what we have to remember that the value of an asset would change depending on the purpose of the evaluation, number one. And based on the purpose of the evaluation, approach will change. And number two, within the approach, the method will change. So if your objective is only to find a replacement value of an asset, which is not the discounted cash flow method, which is only the cost method or the asset approach, so that's where the value is going to be different. But if you want to find out the value of the same asset based on the discounted cash flow, then what you're going to take into account, not at what amount you will replace this equipment or this plant and machinery. In that case, what you're going to take into account is what is the revenue or the cash flow that you will earn from this asset over the years. So that is what we have to remember and be clear about it. Because, and that is the whole purpose behind having this discussion. Because I know as the land and building valuers, as plant and machinery valuer, invariably we tend to use the asset approach or the market approach. It is very rarely that we would use the discounted cash flow approach. And very rightly so, because the nature of the asset that you are doing the valuation of is such. What I have decided to take up a case with you of a hotel, and where even though the hotel is nothing but land and building, it's a combination of land and building. So a hotel can be valued based on the cost approach or based on the market approach. But please remember, a hotel or a hospital can also be valued based on the discounted cash flow. So that is what we have to understand. If the hotel has to be valued as a discounted cash flow, then for us to do the valuation of a hotel as based on this discounted cash flow, first thing that we need to have total clarity about is as to what is the discounted cash flow. So that is what is the objective. So what we can do, we can focus on this for the moment. Yeah, there was someone else who had a query. Please go ahead.
Sir, this is Subramaniam.
Yes, please.
I just wanted to check, your cash flow also every year, the price of the product also,
Yes.
selling price also changes.
Yes.
So maybe it may be related to some inflation or whatever.
Yes. Okay. So
You increase the price and then discount it to the current price.
yeah, okay. I'm going to cover Subhi in this aspect in any case. जैसे हम आगे बढ़ेंगे तो मैं उस point पे आने वाला हूँ. So you can just be with me for the time being, and I'm going to explain, how do you find out the cash flow, and in case if you still have this query, I can take it at that point in time. Is that fine for you?
Yeah, fine.
Perfect. Okay. So now the question is, when and where we use discounted cash flow method, or when it can be used. So as we all know, there are three assets classes that we have. So we have plant and machinery, and we have land and building, and we also have securities or financial assets. Now, under the securities and financial assets, what are the assets that would require valuation? In case of land and building, obviously the valuation would be required of some piece of land. The land can be of different type, or some piece of building. The buildings can also be different types. So building can be of a hotel, building can be of a school, building can be of a hospital, building can be of a dharamshala, building can be of a factory. So in case of land and building, that is what we would do. In case of plant and machinery, of course there are different plant and machineries, and we would do the valuation of different plant and machinery. In case of securities and financial assets, what we would value? Number one, business and equity valuation. So Tata Motors is interested in acquiring Daewoo. So if they have to acquire Daewoo as a company, then what is going to be the value of Daewoo company as a whole? So that is what you will do under the securities and financial assets. You will do valuation of intangibles. So there are different brands, logos, trade names which are sold and bought today. So if let's say, for example, McDonald wants to sell the McDonald company as such, so they would like to know as to what is the value of McDonald as a brand. So that is what we will do, valuation under the securities or financial assets. Then valuation of fixed income securities. So what you have, the companies, all of you would be aware, the companies would issue debentures, companies would issue preferential shares, companies will issue many other instruments, or there are many other instruments available. That those may be the Government of India securities, those may be the corporate bonds of different companies. Now all those securities, those fixed income securities, also need to be valued. So how to do the valuation of those? Again, will be as securities or financial assets. Then you will do the valuation of derivatives, and you will do the valuation of other financial assets and liabilities. Now please remember, where discounted cash flow method can be used, just be absolutely clear about it, because it is so simple. There is no rocket science. Discounted cash flow method can be used in a situation or for an asset which has got capability to generate cash flow, right? So any asset that has the capability of generating cash flow, discounted cash flow method will be used, should be used, or would be used. So here what we are discussing, a business or equity of a company will be valued based on discounted cash flow. Valuation of intangible asset, a brand, will also be valued based on the discounted cash flow. Fixed income securities will also be valued based on the discounted cash flow. How? Because you have taken a debenture of company XYZ. Now what this debenture is giving to you? So when you subscribe for the debenture, you pay 10,000 rupees, and this debenture has a tenure of next 10 years. Over next 10 years, the debenture is going to give you interest at the rate of 10% for next 10 years. So that is what is your cash flow. At the 10th year, the debenture will be redeemed back to you. So that means money will come to you on account of redemption. So you have a cash flow of this fixed income securities happening over next 10 years. So converting this cash flow in terms of present value, that becomes the value of this debenture or bond that you may have subscribed. So again, you can use the discounted cash flow method here. In case of valuation of derivatives, you cannot use discounted cash flow method. In case of valuation of other financial assets or liabilities, you cannot use the discounted cash flow method. Can you use discounted cash flow method in case of land and building? Answer is yes. But when? Only when that land and building has the capability of generating cash flow. So please remember, a hospital will generate cash flow. Hospital is a combination of land and building, but the hospital also has the capability of generating cash flow. And therefore, please pay attention. If you are doing valuation of a hospital, of a hotel, or of a school, and you are doing valuation taking into account only the cost of the land and cost of the building, and arriving at the value of the school or the hospital or the hotel, there is a full possibility that you are doing the undervaluation. And why I'm saying that there's a full possibility that you're doing undervaluation, because this hotel over its life is going to generate much more cash, which is going to be much more in terms of present value than the sum and total of the land cost and the building cost would be. And therefore, the conclusion merely based on the cost of the land and cost of the building as the value of the hotel, or as the value of the hospital, or as the value of the school or the value of the dharamshala is going to be incorrect. So therefore, what has to be done in such a case? So what has to be done is you find out the valuation based on the cost, and you also find out the valuation in such cases based on the discounted cash flow. And then let the client, let the buyer, or let the seller take a call as to what price he would think that he must sell it at, or what price he would think that he must buy it at. So that is the background, friends, that we have to understand and remember. So what is the brief? The brief is, and please remember, and it's very simple. I'm not saying something which is a rocket science. It is very simple. Where can you use the discounted cash flow? Very simple. Any asset that will generate cash flow, the discounted cash flow method can be used. And please remember, when, as I said in the beginning, what is our role, what is our responsibility when we are doing valuation of an asset? Our role, our responsibility is to find out as to what is the fair value. And I'm sure all of you would agree with me. If I am doing valuation of a hotel only based on the cost approach, ignoring the discounted cash flow, I'm sure you would agree with me, it is quite likely that I'm not finding as to what is the fair value of that land, what is the fair value of that hotel, because I'm only finding out what is the cost value. So for me to arrive at the fair value, I will not only have to find the value of the hotel using the cost of the land and cost of the building put together, but I will also need to find out the value of that hotel using the discounted cash flow. And once I have both these figures, then I can come to a conclusion as to what is the fair value of that hotel, of that hospital, of that school, or any other commercial establishment for that purpose. Now, I'm sure all of you are completely clear in your mind as to when and where the discounted cash flow method would be used. Discounted cash flow method would be used in the context of every asset that has the potential and the possibility of generating independent cash flow. Now, before I move to the case study, let me throw it open to all of you. In case if you have any doubt, any question, please feel free to ask me. I would be very happy to take your questions and your doubt. And after that, we will go to the case study. And that is where, friends, what I am going to do, I am going to take every one of you together with me step by step. Tomorrow, if you have to do the evaluation of a hotel, of a 5-star hotel, not using the cost approach, but using the discounted cash flow approach, how should you go about it? Step by step, I would take you. And as I said in the beginning, knowing that all of you are from the side of the, not from the side of the finance, you are from the side of non-finance. And therefore, as I take you through the case, I would make it open to every one of you to please keep raising your hands, keep asking me your doubts, and so that I am able to clear them then and there only, so that your subsequent understanding becomes easy. Yes, please. Somebody, I could see somebody raised the hand. Please go ahead. Yes, Avinash. Yep, you can be a little louder, please.
Good afternoon, sir. I am Avinash from Pune.
Yes, Avinash, how are you?
Yeah, fine.
Yeah, please
sir,
go ahead.
Is it right to use this discounted cash flow method in bank loan purpose?
Bank loan purpose. What loan are you talking about?
Collateral security, mortgage.
Collateral
Advance.
security, mortgage. And what is that you want to mortgage?
Plant and machinery.
Okay, so if you want to mortgage plant and machinery, okay, so will that plant and machinery have the capability of generating independent cash flow?
Yeah, Yeah.
Okay, so will it have the capability of generating independent cash flow without the land and the building around?
Land and building is also there.
Okay, so are you mortgaging only the land and building or
All,
only
all,
all?
all these
Okay.
assets, land and building, plant and machinery, entire plant.
Okay, very good, very good. Now please, look at this way. When you want to raise
Right.
when you want to Avinash, when you want to raise a loan, and the bank is asking you to mortgage the assets of the company as a collateral. Now, please remember what is the purpose of the bank in asking you for the mortgage? The purpose of the bank in asking you to mortgage the land, building, and plant and machinery, or rather all the assets put together to the company, to the bank, their objective is to secure their loan tomorrow. And therefore, and you are doing this valuation for the purpose of the bank and not for your purpose. So you are doing the valuation for the purpose of bank. That means you will have to do the valuation based on what the bank wants. And what the bank wants, when you are pledging the asset as a security, they want to know tomorrow if this company fails to repay the loan to them, if this company, if the bank has to sell the assets in the market, how much will they get if they have to simply sell the assets as assets? And therefore, even if you want to use the discounted cash flow, which you can of course do without any problem, since your purpose is different, since the party for which you are doing the valuation, their purpose is different, even if you can use the discounted cash flow, the bank will say, no, 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 please don't use the discounted cash flow because we are not going to run this company tomorrow. We would simply like to dispose it off in case we don't get our money. So I hope that answers your query. Avinash?
Right, sir.
Okay.
Right. Thank you.
Okay,
Right.
good, very good. Okay, someone else? All right. So if there are no query, then we can move forward. Now, friends, what I'm going to do with you, and I would definitely like to ensure that every one of you is completely clear about whatever I have discussed with you so far. And why is that so? Because whatever I have discussed with you so far is directly relevant to what I'm going to discuss with you now. So if you are totally clear whatever I have discussed with you so far, then whatever I'm going to discuss with you will make sense to you. But doesn't really matter. Even if you still have some doubts, please do not hesitate to ask me any question at any point in time. Now, what we are discussing, you have been approached by the Trident group of hotels for valuation of a 5-star hotel in Goa based on discounted cash flow method. Now, please remember, now what is the purpose here? The purpose in this case is completely different from the purpose about which Avinash spoke just now. Avinash spoke valuation of plant and machinery, land and building of a company from the perspective of a banker. So banker will always be interested in finding out as to what is the amount that they would be able to recover in case if they have to sell these assets. Here, Trident group of hotel is trying to acquire a running hotel in Goa. It's a running hotel. Now please remember, so if Trident has to acquire this hotel, why they want to acquire? They want to acquire so that they will add this hotel in Goa to their chain of hotel that will give a boost to their brand, and they would be able to make use of their brand and earn more profit from this hotel in Goa. So, will Trident be interested to purchase this hotel based on the cost? Please remember, Trident may be interested to purchase this hotel based on the cost of the land and the cost of the building. Why? Because it would be cheaper to them. But the question is, Trident may be interested to do the valuation of these assets based on the cost approach. But the question is, will the current owner of this hotel in Goa, would he be prepared to sell the hotel, which is running hotel, profit making hotel? Will he be willing to sell this hotel based on the cost approach or the asset approach? Answer is no. What he would say? He would say, look, I've spent so much of time, so much of money, so much of efforts for all these years in building this hotel. This hotel is now running hotel, and this hotel is very popular hotel. This hotel is earning good revenue. This hotel is earning good profit. So if you want to purchase Mr. Trident, you can purchase my hotel not based on the valuation of the assets that I have, but based on the revenue earning capacity that I have, profit making capacity that I have, or cash generation capacity that I have. I am sure all of you are completely clear about these two things. So the seller would be interested to sell the hotel based on the discounted cash flow. So if we have to do the valuation of this hotel, doing the valuation based on the land cost and the building cost will not make a sense, will not make a meaning, because the seller will not be interested in that value. Seller will be interested only the discounted cash flow. That means how much money I am going to earn over the life of these assets. What is the value of that money? That is the value of my hotel. So if you want to purchase this hotel from me, Mr. Trident, pay me that amount, right? Okay. So how do we do valuation using the discounted cash flow method of this hotel? That is what we are going to understand. Now friends, let me tell you, there are 9 steps. And I'm not sure how many of you ever have had a chance to do the valuation of an asset using the discounted cash flow. Even if you never had a chance to do the valuation of an asset based on the discounted cash flow, for your comfort, let me tell you, it is not a rocket science. It is not something which is out of the world. This is something which is so easy, so simple to understand and also to apply. We just need to follow those 9 steps. What those 9 steps are, let us go through one by one. And I'm repeating it once again. If at any point in time you have any doubt, any question, please do not hesitate to interrupt me and raise your hand, and I would be very happy to take your doubt, to take your question. Now, please remember, in the beginning we said, what is value? Value is utility of an asset. And what is valuation? Valuation is to convert this utility or quantify this utility in money terms. So if there is a hotel, what is the utility of that hotel? Utility of that hotel is people from all over the world, as tourists, as otherwise, or for the marriages or for the sports, whatever, they can come and they can conveniently stay in this hotel, spend their time and go back. So this is the utility of the hotel, and this is the value of this hotel. I am sure all of you would be very clear as to what is the value of this hotel. The value of this hotel is the utility. And what is the utility? People from all over the world can come here, stay here comfortably, be at ease in Goa and go back after the job is over. That is the utility. What is the value? Converting this utility in money terms is the value. So how do we convert this utility in money terms? So it is very simple. The people will come to the hotel, they will pay the hotel charges, they will eat food, they will pay for it, they will buy wine and dine, they will pay for it, they will use the facilities of the hotel, they will pay for it. There will be a lot of offices given on rent in the hotel, rent will come, that is the utility of it. And the hotel also has a golf course, so people will come and play golf or tennis, they will pay for it, that is also the utility. And the payment that they are making, that is the value of that utility. So the first step, friends, in using the discounted cash flow method is ascertain the explicit forecast period and the terminal period. क्या मतलब है इसका? what is the meaning of this? Now, I'm sure all of you are very clear. All of you are very clear as to what is discounted cash, how to find the value of a property using discounted cash flow. We find out value of a property using discounted cash flow by finding out what is the cash flow this asset is going to give me over its life. And I convert that cash flow in terms of present value by discounting it, total all the present cash flows, present value of the cash flows, and that becomes value of the hotel. Now it was okay, friends, and please pay attention, it was okay if my hotel had a life of 5 years, 10 years, 7 years, 15 years. Why? If my hotel had a life of 5 years, 10 years, 15 years, 20 years, it was very easy for me to calculate the cash flows from the hotel over next 15-20 years. My hotel has a life which apparently is infinity because my hotel can keep on running for years altogether. Now, if my hotel is going to run for years altogether for an unknown period, how do I calculate cash flows for infinity? For infinity, I cannot do that. But as a valuer, I still have to take a decision. I still have to find a value. So what do? I break the life of the asset into two parts. Which are two parts? The part number 1 is known as explicit forecast period, and part number 2 is the period where the explicit forecast period ends. तो उसके आगे का, the entire period beyond that is known as terminal period. Terminal period. Now, what is the significance of breaking life of this hotel that we are trying to value between the explicit forecast period and the terminal period? Explicit forecast period would mean that during this period, my hotel is going to experience phenomenal growth. And let's say, for example, the hotel that we are trying to value has an explicit forecast period of 5 years. How do we decide this period of 5 years? We decide this period of 5 years by discussing by studying the environment, by studying the industry, and by studying the market and forecast and consulting the people. We come to a figure of 5 years. I'm saying 5 years. It can be 5 years, it can be 7 years, it can be 10 years, as the case may be. So first we determine as to what is the forecast period. Now, what is the significance of forecast period? Significance of forecast period is during this period, the hotel is going to experience a very high growth. A very high growth. So let's say the explicit forecast period is of 5 years, and in this 5 years my hotel is going to experience a growth of 15%. After 5 years the growth will normalize, and after 5 years my revenues or my hotel will grow, my revenues will grow at the rate of 5% for rest of the life. So you can see there are two parts. The first is the explicit forecast period and the second is the terminal period. When we use the discounted cash flow, we find out the value of discounted cash flow in two parts. We find out the value of discounted cash flow for the explicit forecast period, and we find out value of the cash flow, present value of the cash flow for the terminal period. And for your knowledge, friends, that is why discounted cash flow method is also referred as two-stage discounting model, because we are doing the discounting of cash flow in two stages: explicit forecast period and the terminal period. And that is why discounted cash flow method is also known as two-stage discounting model. Now, so what we have done, this hotel that we are trying to acquire for Trident in Goa, we consulted the experts and the experts told us that this hotel will have explicit forecast period of 5 years. After that, it will grow normally at the rate of 5%. So that is the information number one that we need to compile for valuation of the asset based on the discounted cash flow. Number two, estimate growth rate in earnings during the explicit forecast period and the terminal period, which is also known as continuing period, and continuing period is going to be infinity. Now, second step also we have completed. That means we got to know that during the explicit forecast period, the hotel will grow at the rate of 15%, and during the terminal period, that is the period that starts from the ending of the explicit forecast period, the hotel is going to grow at the normal rate of 5%. Having done this, now we come to the third stage. And what is the third stage? Third stage is estimate projected cash flow during the explicit forecast period and during the terminal period. Terminal period का मतलब क्या है? The meaning of terminal period is the date on which the explicit forecast period ends, and that day is the terminal period. So what do? We now need to project the future cash flows. So how do we project the future cash flows? Very simple. We will need to find out as to how many hotel rooms this hotel has, how much is going to be the tariff, or how much is going to be charged that the hotel will collect every day for every room. We will need to make a lot of assumptions that what is going to be the occupancy rate of this hotel during the off season, during the on season. During the on season, what rate will be applicable? During the off season, what rate will be applicable? What are the other revenues that this hotel will earn? This hotel will earn revenue also from the offices which it has given on rent to different companies. It will also earn revenue from the golf course and the tennis court which it has. It will also earn revenue from the other facilities that the hotel has. It will earn revenue from the restaurant that the hotel has. It will earn revenue from the banquet hall that the hotel has. It will earn revenue from the business center that the hotel has. It will earn revenue from the training programs that would be conducted by the outsiders in this hotel. So what we will need to do as part of the third step, we will need to do the estimation of the projected cash flow. That means on one hand, we will need to judge, estimate, and find out as to we will need to find out as to how much are the revenues going to be, and we also need to find out how much are going to be the expenses. Expenses on the maintenance of the hotel, expenses on the food and beverage material, expenses on the salaries of the people, expenses on administration, expenses on communication, expenses on maintenance of the sports facilities. So what we will also need to do, we will also need to estimate all the expenses that the hotel will earn over during the forecast period and during the terminal period. And then of course we'll also need to find out as to what is going to be the amount of depreciation, what is going to be the amount of the interest cost, and what is going to be the amount of the taxes, and what is going to be the amount of the net profit for the the explicit forecast period and also for the terminal period. That is the step number 3, which is finding out the projected cash flow of the hotel that we are trying to acquire in Goa. Now here friends, what I would like to make specific mention, and that is when you are trying to prepare projected cash flow, precaution or caution needs to be taken with respect to what? With respect to whatever assumptions that you are making for preparing the projected cash flow, whether it is with regard to the occupancy rate, whether it is with regard to how much tariff you will collect every day, or it is with regard to the cost of the material that you would use, what has to be done? The estimates, assumptions for the projected cash flow has to be as authentic, as accurate as possible. Why? Because if there is any mistake that you commit at this stage, for example, if you overestimate your occupancy rate, if you overestimate your tariff, if you overestimate other revenues, what is going to happen? Your valuation are going to be unduly high. Now, if you are the buyer and you are doing the valuation and you are making this mistake, what is the risk that you will commit? The risk that you will commit is, because being over optimistic in your assumptions, you are going to pay much higher an amount than what you would pay otherwise. So that is the precaution that you have to need to take on both fronts. Step number 4. Now what you need to do, you need to calculate or determine the cost of capital. Now, what is cost of capital? Now this is something which is very, very crucial in case of discounted cash flow method. Friends, since as I believe most of you are not from the finance domain, I would like to be a little more emphatic in sharing with you about the importance of cost of capital. Please remember, in business, every decision that you take about finance of that decision is not possible without having a good understanding of cost of capital. Meaning what? Meaning Trident, which is acquiring this hotel in Goa, having done the projected cash flows, will need to find out what is my cost of capital. Meaning what? Meaning Trident as a group, for buying this hotel, will need to pay to the seller an amount. That amount Trident is going to put into the business for buying this asset. Trident may arrange that money by way of equity, or it can borrow from outside, and that is by way of debt. So what Trident will have to find out? Trident will have to find out what is the cost of this capital. What is the cost to Trident of the equity that I am using for purchasing the hotel and the debt that I am borrowing for purchasing the hotel. So what Trident will need to do? Trident will need to find out the weighted average of the equity and the debt, and that is the cost of capital. This cost of capital, let's say for example it is 15%. This 15% rate will be used for converting future earnings, future cash flows from the hotel in Goa by Trident, for converting the future cash flows in terms of present value. Little while ago I mentioned to you what is present value, and little while ago I mentioned to you why the future cash flows need to be discounted in terms of present value. And I'm sure you would recollect, I mentioned that future cash flows need to be discounted in terms of present value because the value of the money changes with the passage of time. 100 rupee in my hand today, or 100 rupee in my hand 1 year from hence today, hence is not same in value as 100 rupees in my hand today. So if I have to take a decision, I need to convert the future cash flows in terms of present value. How will I convert the future cash flows in terms of present value? I will convert the future cash flows in terms of present value by using this cost of capital. Right. So that is your step number 9. Step number 4. Now please remember, when you are using discounted cash flow method, you are calculating the cash flow, and the cash flows that you are calculating can be of two types. Which are those two types? Number one, the cash flow can be free future cash flow for the firm, free cash flow for the firm, FCFF, free cash flow for firm. Now, what is the meaning of this? Meaning of this is the cash which is generated from the hotel and which is available for all the stakeholders. Or it can be FCFE, free cash flow for equity. And what does it mean? It means that this cash flow is available only for the equity holders of the company. So this is what you would do. So you will find out the FCFF, or you will find out the FCFE. Please remember, little technical, I can understand. So if you are using free cash flow for the firm, FCFF, if you are using FCFF, that means it will give you the value of the entire business, and that cash flow will need to be discounted by the weighted average cost of capital. But if you are using the FCFE, which is free cash flow for equity, you will be using cost of equity for the purpose of discounting. Now, so this is what you will do. So having ascertained all the cash flows, you will do the discounting of those cash flows, and that discounting will give you the present value of the business. Now, so that is point number 5. Compute the present value of the explicit forecast period and the terminal period by discounting the FCFF or FCFE. As I said, if it is FCFF, discounted by using weighted average cost of capital. If it is FCFE, discounted by using cost of equity. And that is what you would do. So, अब आपने क्या किया? What you have done, you have found out the present value of the explicit forecast period, and you have found out the present value of the terminal period. Add them together. Add the present value of the forecast period and present value of the terminal period, and when you add them together, that becomes the value of the hotel based on the discounted cash flow method. But remember, it doesn't end here. You still have to make certain adjustment. And what adjustment do you have to make? And why do you have to make these adjustments? Let us understand it. While calculating the value of the hotel using the discounted cash flow, what you have done? You have found out how much cash would I generate from the operations of this hotel over the forecast period and the terminal period. But remember, it is possible that this hotel may have certain other assets. Say for example, this hotel that we are talking about in Goa, whose valuation we have arrived at, let's say that amount is coming to 1000 crore. So having used the discounted cash flow method, the value has come to 1000 crore. Now we come to know that this hotel that we are trying to acquire in Goa, it also has a piece of land which is lying vacant at a distance of 5 kilometers from the hotel. And that piece of land is worth 100 crore. Now my question to all of you will be, what do we do with this value with the value of this land which is lying vacant at a distance of 5 kilometers, which is worth 100 crore? Do we have to take that value of 100 crore into account while doing the valuation of this hotel, or do we just ignore it? The answer is, of course, we have to take.
No, we cannot add because it is not income generating.
Okay, very good. Okay, very good. So, Dipankar, now please remember, this piece of land which is worth 100 crore, who does it belong to? Does it belong to the same company which is owning this hotel, or does this piece of land belong to somebody else? Dipankar.
Sir, it belongs to the same company, but for the land, I think we should use the अपना cost approach कि हमको कितने मतलब अगर परचेज करनी हो हमें कितने में मिल जाएगी.
Perfect.
उसमें हम अपने डिस्काउंटेड कैश फ्लो इसमें नहीं लगाएंगे.
Very good. Perfect. Now please pay attention. For doing the valuation of that piece of land which is lying vacant, obviously you cannot use the discounted cash flow for the reasons that we have discussed already at length. So we will have to use the cost approach for the valuation of that land. But please remember, Trident, all of you please pay attention. What Trident is doing, Trident is acquiring the company that owns this hotel in Goa and also all the assets which is owned by this company. So if Trident has to acquire this company, so hotel will come, and together with that hotel, this piece of land which is lying vacant somewhere will also come. So if that piece of land is also coming to Trident as part of this company, will the owner of this hotel, the present owners of this hotel, will they give this piece of land to Trident free of cost? Or they will say, all right, 1000 crore you pay for the hotel, but this land that we have, which is also part of our company, is worth 100 crore. So you have to pay 100 crore for that also. Isn't it, Deepankar?
Yes, sir. Correct.
Yes, correct. So now what we will need to do for doing valuation of this hotel, for doing valuation of this company, we will have to add 100 crores also to the 1000 crore. But at the same time, please remember, this is how you will do the valuation. You will make the adjustment. On the practical side of it, there can be another situation. What can be another situation? The another situation can be Trident would say, Mr. X, we are interested in buying only your hotel. We are not interested in buying that piece of land. So you please keep that piece of land with you. We are not interested. We are interested only in the hotel, and the value of that hotel based on the discounted cash flow is coming to 1000 crore. We will pay you 1000 crore and take only the hotel, and that piece of land will remain with you. And that is what exactly has happened. I am sure all of you would have noticed. That is what exactly has happened in case of the Government of India and Air India and Tatas. So what Tatas have purchased, Tatas have not purchased the entire Air India that it was before Tatas acquired. So a lot of assets that belong to Air India, Tata said that we are not interested in all those assets. You please keep those assets with you. We are only interested in purchasing operating assets of Air India, and that is how the transaction has happened, right? So this, my friends, how you will make the adjustment, and this adjustment, please remember, is necessary depending on the situation. So it is not that in case of every valuation that you will do using discounted cash flow, there may be some asset of this kind lying. It is quite possible no such asset may be lying, and in that case you do not have to do anything about that, right? So step number 8, amounts arrived at after making the adjustment. So let's say in this example, for the sake of simplicity, the Trident said, all right, we will buy the hotel and we will also take that piece of land, because that piece of land is going to be useful for us for the expansion program subsequently in future. So we will pay you 100 crore for that, and we'll pay you 1000 crore for the hotel. So all put together we will pay you 1100 crore. So Trident is telling the seller or the current owner, we will pay you 1100 crore. So that is at this point number 7. Point number 8, amounts arrived at after making the adjustments will be enterprise value in case of FCFF, free cash flow for the firm. If that is what we have used, then it will be enterprise value. But if we have used only FCFE, free cash flow for equity, then it would be known as equity value. Now what we have to do? So at the time of after the step number 8, now what do we do? Whether it is enterprise value or it is equity value, jitne bhi whatever is the number of shares of this hotel is having, so we divide the equity value by the number of shares, and we come to know the value per share, and this value per share will be used by Trident and the local buyer for doing the transaction. Now please remember, will the transaction happen on the value per share that I have arrived at? Answer is not necessary. And why the answer is not necessary? As we all know by experience, as valuation professional, what do? We do the valuation. Valuation of what? Valuation of fair value of an asset or of a liability. So fair value is what we are giving as a reference point. Now at what price the transaction is done will depend between the buyer and the seller. So let's say, for example, in this case, we come to a price of 100 rupees per share. After using the discounted cash flow, the value is coming 100 rupee per share. Now it is between Trident and the local owner whether they want to do the transaction at 100 rupees, or they want to do the transaction at a lower price, or they want to do the transaction of higher price. A question can come to your mind as to why higher price or lower price. Higher price or lower price can be, number one, the seller is in a distressful condition. He has some challenge, some difficulty. So he wants somehow to get out of this hotel and get cash so that he can use that cash for some purpose that he has to fulfill. So he can say, all right, Mr. Trident, if 100 rupee is what you think is too much for you, I am prepared to sell it for 95 rupees. So the transaction can be done at 95 rupees even though I gave the fair value to be 100 rupees. It can also happen the other way around. Trident realizes that they have got hotels all over the world, but they do not have a hotel in Goa, which is one of the most touristic place all over the globe. So Trident say, all right, just to ensure that I have a presence in Goa also, Trident may say, all right, I am prepared to pay you a premium of 10 rupees over and above this 100 rupees which is coming the fair value, and please sell this hotel to me. So that is a matter of discussion and negotiation between the buyer and the seller, and that is how it will be done. So friends, this is how the discounted cash flow method which is used for the purpose of valuation of assets. Please remember one fundamental thing, and that one fundamental thing is every asset, be it company, be it plant and machinery, be it land and building, every asset that has a potential of generating cash flow, that asset can be valued based on the discounted cash flow method. That means what? That means the prime condition for application of discounted cash flow method is that the asset must have the capability of generating cash flow. If an asset cannot generate cash flow, then that asset cannot be used, cannot be valued as a discounted cash flow. For example, I am sure all of you would be aware, all the companies that are on the verge of closure. So the companies which are on the verge of closure, now valuation of those companies will not be done based on the discounted cash flow because the companies are in such a bad state that they will not generate cash flow. So those companies will be valued only as a cost approach or liquidation value. So friends, with this I come to the close of my session. In case if you have any question, I would be very happy to take them. Over to all of you.